buyers got a little bit of a gift last week as interest rates dropped from 7.2 to 6.8% nationally. Now, this move was very much unlike the move that we saw back in December when investors jumped the gun, when Powell clearly said that he expects 3 rate cuts in 2024. They heard 6, and rates had dropped substantially, giving us a beautiful 6 weeks run of 6.6% interest rates. Well, when investors realized that the economy wasn't really substantiating that kind of rate cuts in 2024, of course, we saw the interest rates move back up again. Until last week, we actually saw several reports come out showing that maybe the economy is slowing down slightly. I mean, we're still seeing Bitcoin and the stock market hit record highs. I'm not saying we're going off a cliff, and I don't even know that we're going to enter into a recession. But slowing down and normalization of job market or the labor market and the economy is a good thing. It's a good thing for interest rates. So we saw them tick down. I want to go through some of the reports that we saw this last week, what happened on Friday, and then what happened with the CPI report, and how low will interest rates go, and what's Powell's next move. I want to go over all of that. But before I do, I have a massive favor to ask. If you dig content like this on all things housing and economics, please make sure to subscribe to our channel. It helps us reach more people just like you. And if you like this video, make sure to like it, comment down below, and share it. So ISM Services came in as the first report. And remember, the GDP, the gross domestic product, the measure of the United States output, is typically measured in 2 buckets: manufacturing and services. And we're not really a manufacturing country anymore. I mean, we used to do a lot of it ourselves, and now we import a lot of our goods. So we're really a services country. Think about the restaurants you frequent, or the travel that you do, or the services that you employ. That services measure, as ISM Services, is significant because it tells us the majority of America, how's it faring, and it fell 0.8%. 0.8%, not a massive fall, and certainly not into recessionary territory, but certainly a little bit of a slowdown in February. Job openings came in, and they ticked down by 26,000 job openings, down to 8.9 million. Now, remember, we had hit a high of 12.2 million job openings 2 years ago in March. So that's significant. The fact that we've started to normalize the amount of job openings that are available to all Americans looking for a job says that we're starting to see a labor market imbalance. Another report that demonstrated how our labor market is returning to balance was the quits rate. It had dropped to 2.1%. To put this into perspective, this is the lowest it's been since August 2020. So what exactly does that mean? That means less people are leaving their current job to go get a significant pay raise at a new job. Those employees are staying at their current job for longer because it's not necessarily greener on the other side. And then Friday came. Friday gave us a pop of the jobs, wages, and unemployment numbers. We saw an increase of 275,000 jobs in February. We were only expecting 200. Realistically, our interest rate should have jumped up with that news and gone negative or higher, but that didn't happen because January, which was also higher than expected, was revised down by 124,000 jobs. So it's fully expected that February will also be revised down by the BLS. Wage growth also is moderating. It had dropped from 4.5 to 4.3% increase in wages annually. But this is still over 4%. So yes, it's coming down. Yes, it's moderating, but it's still a little too high. I want to double click on this because we have to think about the wage spiral. Wage growth is a big portion of our inflationary numbers. I mean, if you think about it, if I'm an employer and I have employees and I'm also selling services or goods for that matter, and I have to pay my employees more, then I'm going to charge the consumer more for that good or that service that we're selling. And because that good or service is now costing more, then those people who are consuming those goods and services are now going back to their employment looking for higher wages to justify the higher prices of everything. So wage growth tends to become a cycle. I mean, if you think about public services or teachers, I mean, what do they get? They get a 1% wage increase every year. We're seeing it over 4. In fact, it's at 4.3 annual. That needs to keep coming down for inflation to sustainably get closer to that 2% that Fed Chair Powell is so dearly looking for. Then the unemployment number came out, jumping 0.2% from where it had sat for several months at 3.7% up to 3.9%. But it's still under 4%. But remember, recessions happen and slowdowns happen when unemployment rates are at their lowest and they start to jump up. We'd been watching the SOM rule, which compares the current unemployment to previous months' averages. So we'll continue to watch this. But that jump was big, but was it big enough? That's the dichotomy of what we saw on Friday's job report. Is literally bipolar, giving us two sets of data inside the same set of reports. And then the CPI report came out, the Consumer Price Index. This measures inflation that you and I feel when we go to the grocery store and buy a gallon of milk, or we go fill up our car with a gallon of gas. It's the kinds of things that we feel with our health care deductibles. That CPI came out, and it's showing signs of being sticky. It actually came up 0.4% when we were only expecting it to go up 0.3%. Now, all of this has Powell kind of tapping his forehead going, we might have been right. Like, we said we needed to slow down. We said we needed to stay here higher for longer. We said that we were going to drop the Fed rate 3 times in 2024, but we certainly didn't say when. And we are not there yet. He's dancing this fine line between throwing the economy into a recession and holding us long enough to pull us off of inflationary highs. Because if he drops that Fed rate too soon and people start spending more because the cost of money is lower, then we're going to see inflationary pressures go back up again. So this reaffirmed his need to stay put for now. And in fact, we're watching the probability on the Fed Watch tool of when he's going to drop that first rate cut. And March, we already knew was off the table. Now the May cut is getting further pushed out. Is it June? Is it July? Or is it even September before we see the Fed rate start to drop? In the meantime, we're seeing interest rates hovering right around this 7%, whether they hit the high of 7.2 or really go high to 8%. But really, they're dancing between 6.6 and 7.2%. A lot of people had judged that unless interest rates went down, unlocking sellers from their 3% current interest rates, that we wouldn't see inventory. But here's the interesting statistic. Fannie Mae's confidence survey just came out showing that 65% of sellers say it's a good time to sell a home. It's a good time to sell a home. Had they checked interest rates lately? I mean, interest rates have been bouncing between 7.2 and 6.8 or 6.6, and now is a good time, or are they just tired of waiting? Of course, we're entering into the spring season, and in December, we had seen interest rates coming down, and a lot of sellers were preparing their homes ready to sell. In mid-December and early January, when we saw rates dropping from their highs back down to 6.6 and staying there, sellers were thinking, this is it. This is when interest rates are going to come down. They start preparing their home and putting it out on the market. Meanwhile, interest rates had double backed and gone back up again. But mortgage purchase applications jumped 11% in the last week's report, and that's a 1 week over week as rates hit a 1-month low. So demand is coming out in respective to interest rates. We're seeing sellers come out because either they're done waiting or maybe they just prepped their home and they're not going to pull it back off the market. They're just going to leave it on. So across the country, we're seeing more inventory. In fact, Denver here, we saw 46% more active listings at the end of February 2024 than we did February of 2023. I mean, we're seeing significantly more active listings come out and 23% more new listings from last year. Well, as all of this is happening, we have to realize that buyers are ready. Some are waiting for home prices to drop, or some are waiting for the interest rates to come back down again. And others have decided that the opportunities of more new listings and more active inventory is their time to go ahead and purchase and then refinance down the road. Did you know that there are 12,000 Americans turning 35 every single day? And 35 years old is the current average first-time homebuyer. My expectations is that this average homebuyer age will go down as Gen Z doesn't have the same stigma around home ownership that millennials do, who saw their parents lose money during the housing recession. The Gen Zers don't see it. That 35 could start coming down. But right now, if 35 is a first-time homebuyer average age, and there are 12,000 Americans turning 35 every single day, that statistic of 4.2 to 4.7 buyers sitting on the sidelines waiting for rates to drop or just waiting for opportunities with new listings to come on market are seeing those new listings, and they're putting bids in. And we're seeing new listings come out. And on that same day, we're seeing 20, 30, 40 showings. And we're seeing 3, 5, 10 offers over asking. I've seen as much as $50,000 over asking. And then there's Biden's State of the Union address, where he reiterated his desire for more affordable home ownership. Now, if you remember, before he was elected, he came running on a platform of affordable homeownership, and I frankly loved it. I loved the fact that he had fully formed and that he put it out on a public website. It was the first president that I can remember that had done so. But then regretfully, once he got elected, we really did not hear that much more. Well, now he's coming out reiterating the $25,000 first-time generational buyer. While mortgage lenders are scratching their head trying to figure out how do you determine who's a first-time home buyer and a first-time generational buyer. He also is talking about a $10,000 tax credit to first-time home buyers and sellers of starter homes. Define a starter home and how we determine who gets that $10,000 credit. Either way, that $10,000 credit is spread over 2 years, $5,000 for the first year when you get your tax refund and $5,000 the second year. All of that to say, as it is pushed through Congress, it is highly unlikely that any of this will happen or go into effect before the next term. Zillow also just released a study that showed how much the average income needed to be for an American to afford an average priced home. Denver did not fare well. As we remember, the Common Institute had ranked Colorado as 51st amongst all the states and the District of Columbia. Well, Zillow's report showed that the average Denver home would require an average income of $172,700 annually. That was to get a 34% debt-to-income ratio. Now, I question, when was the last time we did a loan where we had a 34% debt-to-income ratio, especially for a first-time home buyer? But it does reiterate the unaffordability as home prices continue to go up. And per DMAR's last report, the average home price was up 3% year over year. If I take the year-to-date median home price, we're actually seeing a 5% increase already this year in January and February alone. Yet pendings were up 13% month over month and closed were up 31% month over month. So buyers are still active and they're willing to pay more for their home prices. And in fact, for the right home that's staged well and priced right, they're willing to pay over asking. So ultimately, those buyers who are sitting, waiting for rates to drop are going to need to wait a little longer. And it's not going to be May, and it very well might not be June, but July or September before we see the Fed start to drop the Fed rate, before we see inflation start to come down more systematically, and before we see interest rates start to take their drop. And ultimately, if those waiting for home prices to drop, I have to say, it's not likely. So if you're done waiting, if you're done sitting on the sidelines and you want to take a more active stance in your building financial wealth and stability through home ownership, make sure to give us a call. Reach out, put comments down below. And if you don't have a real estate agent already that you're using, we have an incredible team of real estate partners ready to go to work for you. Nicole Ruth with the Ruth team, it's my pleasure to keep you updated.